Hello, and welcome to eOption's webinar. We're happy to have you here, and thank you for taking the time out of your day to join us. We're excited to partner again with our speaker, Teddy Keckstadt, a professional trader with over 30 years of experience, to bring you this webinar today on Enter the Options Trading Ring with a Knockout Trading Plan. My name is Gina Bocayas, and I'm with Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And to provide you some basic logistical information, the session today will last approximately 1 hour. If you have any questions, we're happy to answer them for you. All you need to do is find the Q&A box on your screen and enter those at any time during the presentation. And our speaker, Teddy, will answer all of those at the end of his presentation. Please use the Q&A box and not the chat box, as our speaker won't see your questions if you don't enter them in the Q&A box. You'll be able to access the recording of the webinar in the next few days on our website at eoption.com, and we'll also be emailing you a copy of the recording in the next week. And you can also find it on our YouTube channel if you subscribe to us. And for those of you just joining, we'd like to welcome you to our webinar on Enter the Options Trading Ring with a Knockout Trading Plan. And as eOption's name implies, we are a firm that specializes in option and stock trading. Our founder was a founding member of the Chicago Board Options Exchange in the 1970s and has been trading stocks and options for nearly 50 years. We charge some of the lowest option rates in the industry. All of our stock and ETF trades are commission-free, are just zero commission for all online trades, and options are just 10 cents per contract plus $1.99 per trade. We also offer a powerful trading platform, mobile app, free trading tools, and live expert support on our trade desk. And that's something we're very proud of, is our excellent customer support, where you can reach out to a licensed broker, a professional with years of experience, and they're happy to answer any question that you have. We also offer a useful options trading tool called Options Play, which scans thousands of stocks each day to highlight potential option trade opportunities for you. Now, this is normally $500 annually, but this is free to all of our customers. We also support option education, and we're glad you can join our webinar today to learn more about using options in your overall trading strategy. And I'd like to now turn your attention to our speaker, Teddy Keckstadt. Teddy has over 30 years of experience in the financial industry and trading. Some of you may recognize his name from past webinars he's done for eOption, and we're excited to welcome him back today. And just to tell you a little bit about him, he has over 30 years of trading and industry experience. He traded at the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he's been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked, and he is the author of the book, High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Keckstadt now. Thank you.
Thank you, Gina, for that introduction, and thank you to all of you out there who are coming to participate and watch this webinar. Enter the Options Trading Ring with a Knockout Trading Plan. Okay, we don't have to talk about myself since Gina gave that fabulous introduction. Thank you once again. Real quick, we have to show you our disclaimer from eoption.com to remind you that this webinar is for illustrative and educational purposes only. Remember that everything we view is in a lag and stuff like that, so for the market data. And since I am doing this presentation, I always throw up my company disclaimer as well. All right, get ready to rumble with options. Okay, so what you will learn today, you're going to learn how to trade stock and other market movements without large capital allocations. Expanded portfolio diversification is something else you're going to learn. How to maximize your potential returns with options. Bear and bull directional strategies will be talked about today. And you're also going to learn to see how eOption can help improve your bottom line with your options trading. So why stock option strategies? Well, first of all, you can lower your cost basis. At eOption, it is only 10 cents a contract, much lower than other firms. Options help you diversify your portfolio because you can trade a much broader range of stocks with your allocated capital. which is also something you always want to be mindful of, because money management is definitely one of your key variables for success in trading and investing. Options allow smaller to larger investors the ability to capitalize on trending markets that are highly liquid. This is a very important cost control. The nice thing about regulated, publicly traded options that you would trade on most equities, they're very, very liquid at all times. Now, what does that mean? That means that the spread between the bid and the ask is usually very, very tight. The tighter it is, the better it is for the customer. The less edge you have to give up. The more edge you give up, the more you will add to your losers and decrease your winning potential. So be very mindful of where you have your liquidity for where you trade and place your options positions is also very important. You know, the tighter your spread, the better your broker, the more it saves you money, increases your bottom line no matter what. Trading in these products is similar to trading in normal equities, but with higher potential ROI and controlled risk. Yes, that's true. Your return on investment definitely has a higher potential with options and option strategies. Okay, today's focus. We're going to talk about credit spreads, which are a type of spread known as a vertical spread. We're also going to talk about debit spreads. They're kind of the same thing. It's just a matter of one you get a credit, one you get a debit. It's pretty much that simple. They are also vertical spreads. We're also going to talk about puts. We're going to talk about calls. We will discuss bullish and bearish strategies, how you would apply which strategy at which time, depending on whether you're bullish or bearish. We're going to show how you can define your risk. We're also going to show you how simple the execution is. And we're also going to evaluate the short-term versus the long-term opportunities with these strategies. Okay, we're going to get to the charts really quickly, but we just want to make sure we have these definitions. Some of you out there are very experienced options traders and have been involved in the market for maybe even longer than myself. Others have probably only been are brand new to it. So we're going to go over these real quick so that you understand the strategies once we get to the charts, what we're talking about. So definitions, buying a call. When you buy a call, that means you have the right, not the obligation, to buy an asset at a specific strike price. That is a long play. If you sell a call, then you give the buyer the right to buy an asset at a specific strike price. That is a short play. Okay, I just want to make sure you're very clear on that. The same goes for puts. If you sell if you sell a put credit spread, you sell one put option strike price of an asset below the market, and then you will simultaneously buy a lower put option strike price with the same expiration. Now, ideally for vertical credit spreads, 2 to 3 weeks is the best time frame. If you start to go out longer than that, they are not that good. And you will see through our examples and where the market's at today why that is true. We're going to learn a little bit about the Greeks today. You're going to learn about time decay and theta, but instead of having to worry about all kinds of numbers, you're going to learn visually, and by the time we're done, you're going to be like, oh, I have a better grasp of time decay. Okay, so if you sell a call credit spread, that it would be when you sell one call option strike price of an asset above the current market and buy a higher call option strike price with the same expiration. This also ideally is something that you want to execute with no more than a 2 to 3 week time frame before expiration comes. Now, we're going to talk about debit spreads also. If you buy a put debit spread, you will be buying one put option strike price of an asset below the market, and you will simultaneously sell a lower put option strike price with the same expiration. Now, if you're going to sell a call debit spread, then you would buy one call option strike price of an asset above the current market price and sell a higher call option strike price with the same expiration. Okay, we got through the definitions. Now it's time to have some fun. Okay, directional option plays. February 12th expiration. Today is February the 10th. In 2 days is expiration. When I made up the slides for this webinar, I decided, because of the topics, I looked at the pricing for the options, and now we'll see how things would have panned out, whether you were a bull, a bear, and which play you might have chosen. Okay, so for long plays, one way to be long any type of equity or ETF for that matter, or even other markets, would be to buy a call. The nice thing about when you buy a call is your risk is defined. The only amount of money that you can lose is what you pay for the option, also your commission for the option. That is the most that you can possibly lose by a long play when you buy a call option. Another long play is when you sell a put. Okay. Now, the thing about that is you have unlimited risk when you sell a put. So there is a big difference between when you buy an option and when you sell an option. Okay. But now, as far as being a long play, if you sell a put, that is the same thing as being synthetically long is what it is, but it has unlimited risk. Now, if you sell a put credit spread, which is one of the things we just discussed, your risk is defined. So that would mean that you would take a credit in when you simultaneously sell and buy some put options of the same expiration date, but your risk is defined. So no matter what the market does, whether it stays still, rallies to the moon, or crashes to the floor, it doesn't matter. Your risk is defined. You can only lose the difference of what your credit is, and we'll get into that pricing once we get to the examples. The same thing is for if you buy a call debit spread, your risk is defined. That is another long risk-defined play. Now, the other thing you could do is you could buy an asset, high capital outlay. That's the problem with that when it comes to when you actually get into only trading the equity itself or the ETF or whatever market it happens to be. As far as short plays, that is when you would sell a call. Now, this is where the risk is unlimited. Once again, when you sell an option, you have unlimited risk if it goes against you. Now, if you want to do another short play, buying a put, there your risk is defined. The most that you can lose is the purchase price of the option plus your commission that you paid. So should the market rally to the moon, your put expires worthless, that is a defined amount of money that you know that you could possibly lose. Another short play would be to buy a put debit spread. The nice thing, once again, about a debit spread is your risk is defined. However, a debit spread is where you would definitely pay to put on the spread. The next one would be to sell a call credit spread. And this is another nice thing about this is even though you are selling options, your risk is defined. So the nice thing about these vertical spreads, if you are selling them, whether they are debit or credit spreads, unlike a put or a call, if you sell them, your risk is defined. Remember, if you're just in a put or a call, your risk is unlimited. This is big to know. Remember all those hedge fund guys that were out there when when the GameStop blew up in their face, they were all short a stock. They were not hedged. Shorting a stock has unlimited risk. So those geniuses, and the oxymoron is a hedge fund manager, because hedge fund managers never hedge. If they had some options on, even some way out of the money calls, they would have covered and not have lost the amounts of money that they did in that short amount of time. Of course, hindsight is always 20/20. You think they would know how to do that. So anyhow, if you sell an asset, high margin and unlimited risk, that would mean shorting the stock, like the hedge fund guys that got blown up 2 weeks ago. So that I'm sure everyone knows at least something about that that's watching this webinar. Okay, our first example. Now we can get into the visual aspect of this webinar. Now it'll start to make sense what we're talking about and what we're doing. Okay, Amazon.com, everyone's familiar with the stock Amazon. At the time when I produced this slide a couple weeks ago, Amazon was trading at $3,232.58. Now, here, let's figure out what you could do. If you wanted to go short this market, instead of shorting the stock, which we know has unlimited risk, you would buy a put up here. So since the market was at 232, you would buy a put below that at, just above it at 32.35. Now at that point, that option would cost $139.04. Okay, that's what the pricing is here. But actually, you got to remember, anytime you're looking at options, you have to multiply times 100. So that's a very expensive option, but not as expensive as trying to short the stock, right? So we'll get into that pricing. So one thing you could do here is buy that put for $139.04. Or if you wanted to be a bull, you could buy the 32.30 call just below the market for $147.90, obviously times 100. So that would be right here. We have your 32 30 and 32.35 marked here on the chart. You can see how where the close was of this long down day. This was when the webinar was done. We have above here in blue, these are your calls, and we have your puts marked here in red. Okay, so these would be ways that you could go short or long. Now that would also, what you could do is you could sell the options. Now remember, when you sell the options, then you start to bring in that unlimited risk factor. So the same prices would be there, and then instead of paying, you would be bringing in that amount of money. So these first two examples where you're buying either a put or a call because you are bullish or bearish and you want to trade Amazon.com, you don't want to put, obviously either put up the money to buy the stock or have the margin to cover the short. And remember, you better have the margin to cover the short because it is a lot. So you're going to tie up a lot of capital with that. Suggesting to go short the market, buy a put instead. That's what I always say. Never go short the stock market. But that's my own personal opinion. So also the flip side here is you could sell these options. There are reasons to sell options. Just because I'm warning you that you have unlimited risk, remember that most options expire worthless. That has to do with the whole flipping of spreads and what have you. Not everyone is having a hedge on or what have you. There's all kinds of reason for the market mechanics of that. But remember that the ones that do expire and are exercised on or used, somebody had to sell those. So in this case here, you would be bringing in some nice money. If you sold the put, you bring in $13,904. If you sold the call, you bring in $14,790. Not a bad way to start off a trade, right? But excuse me, remember that you have unlimited risk. Now let's go to the credit spreads. 32.35 call for $145 is what you would be selling, and you would be buying the $32.45 call above that for $140. If you did that, you would have a credit because you're selling the closer option for more money than you are paying for the other option above the market. So these are these blue ones. The first one you'd be selling, the upper one you would be buying. Now remember, this credit, this is the difference of what, this is where the only amount of money that you can make on a credit spread would be the money, the premium that you take in from the simultaneous buying and selling of these options. Remember, they also have the same expiration date. And then obviously your commission also would be, that would be the most that you could lose on the trade. And it would also be, that would be the most that you can make on the trade, which would be minus the commission. Now, what you could lose would be the difference in that spread between your strike prices. So in this case, we have the 32.35 call and the 32.45 call. That's a $10 difference right there, okay? So we'll get into the numbers on the next slide, but this would be a little over $5. This would be a $5.40 credit. So your risk then would be a little less than $4 or a little less than $5. Now on the credit spread to the downside would be the put spread where you're long. Remember, when you sell a credit spread that's a call spread, you're bearish. You want the market to go down. If you sell a put credit spread, you are synthetically long. You want the market to go up. So if you are bullish Amazon.com, you don't want to put up the, well, let's see, $3,282 a share today. Add that times 100, that's a lot of money, The option would be, the spread would be a lot cheaper to go along. Now, remember, when you put on a credit spread, though, you can only make the difference, or you can only make the credit that you received from those, the spread on those options. If the market goes to the moon, it doesn't matter, but it's good for you because the higher it goes, it just locks in your position. You can then sell out of the spread and then you lock in your return. So now we'll look at the debit spread. Remember, a debit spread is where you're actually paying for it. So the pricing is the same. The only difference is that you would be buying the 32.35 call in this case, and then you would be selling the 32.45 call above the market. So in that case, you are paying a little bit more than you're bringing in from your spread, okay? But then your money still, though, is the opposite on what you can make on that spread. So basically, one way you get a credit, you get your money up front. The other one is you put money up front and then you have to wait for your spread to expire, and that's how you collect your money when you roll out of it. So it'll all start to make sense in this next slide here. So your vertical spreads with an expiration of 2/12/2021 that we were looking at there. If you were to put on the call credit spread, that would mean you would be putting on a short position, okay? Instead of selling the stock outright in Amazon.com, which would have a limited risk, or buying a put. Remember, we talked about that as another way to go short. A call credit spread is a great way to go short here. Now, you would be selling that 32.35 call with the February 12th expiration, which you would be bringing in $145.43. Well, actually, it's actually more than that. We'll get into the pricing. But then you have the option that you're buying, which would be the $32.45 call, which is above the market, above that, for $140.03. Remember, you have to multiply everything times 100, but it doesn't matter because the credit here still is the same no matter what you put the dollar amount or the option quote price. So your credit would be $5.40 or $540. So that would mean that if you put on this spread, when we put on these slides, if you would have sold the credit spread, you would have brought in instantly for that one option, selling it for the 32.35 call and buying one option of the 32.45 call strike prices, you would have a credit in your account for $540. Now the risk, because it's $10 wide, would be $460 because it's $10 wide, it's $1,000. So you're bringing in $540. The most that you could lose is $460 if the spread was to blow up in your face, okay? Because you already took in $540, so $540 minus $1,000 would be the $460. So you know what your defined risk is, it's $460, and you know that right off the bat, you already took your money in. So if you're correct and the market goes down, your money is already in your account, and you can always roll out of the spread and take money early if you want to before expiration. Now, also, you could put on a put credit spread. Remember, that's a way of going long the market. So that's when you want Amazon to go up. So you would be selling the credit spread below the market. So in this case, you would be selling a 32.30 put for $142.46, and you'd be buying the 32.20 put for $138.30. This would give you a net credit of $4.16 or $416. Now on the put spread, this one has a little bit higher risk because it's $10 wide, which is $1,000. You're bringing in $416. So your risk then would be the $584 difference there. So that would be the difference. You have a little bit more risk on this put spread than you would have the call spread. But remember, one is a short position, one is a long position. So depending on what your rationale is for Amazon and if you were to trade this, these would be ways of looking at it. Remember, you could buy the stock. We know how much that's going to cost you, which you have definitely unlimited potential to the upside and you have a limited downside risk, but no matter what, you have a risk to the downside there. It's not controlled. Now let's look at the debit spreads. If you do the call debit spread, you would be long once again, and that's where you would be buying that $32.35 call and you for $145.43, and you'd be selling the $32.45 call for $140.03. You would have a net debit of $540. This is just a flip side. The debit is just the flip side of a credit. Okay, so that's why these numbers are the same. You just have to remember that it's negative. So in this case, it would cost $416 to put on your debit spread to go short, and it would cost $540 to go long or with a debit spread, just to let you know. Now, to give you an idea of option pricing, today, these numbers here, like we'll start out with this call. This call right here is $145.43. That's selling this $32.35 call or buying it. So whether it's the credit spread or the debit spread, right there, this $145 is now $56.95. So in just 2 weeks, the dollar amount has decreased by 60%. Okay, and there's only 2 days left. So that's a big deal. And the reason that you have this difference, and the irony is the spread is actually still pretty much around this. It's just a little bit different. You could actually put a credit spread on now in these markets for a little bit more than you could back then 2 weeks ago. In fact, you could do it now this same spread that was $540, you could sell this credit spread in the same options market right here, these same prices, with 2 days left to expiration, where you would have a credit would be of what, $7.50. So $750 with only 2 days left. So this is where, when you only have a couple days left and you are just expecting the market to go down in a stock like this, you put on a credit spread like this, you only have 2 days of risk, and and the amount of money you're risking also then would be less than $300. So time is already gone out of the equation, because that's where these prices have gone down, and you can utilize that in the pricing of today's current markets. So now let's see what we would have done here. Let's just say you would have bought 100 shares of Amazon at $3,232. You would have had a debit of, this would be $323,258 in your account. So just to go long 100 shares, if you were a bull, this is how much money of your capital you would have to absorb. If you were to buy the 3230 call, remember we talked about just buying an outright call, it would cost you $14,790. Now, the nice thing about the call is, just like being long, if the market goes up, you're going to make money on that. If you were to look at that call right now, though, because Amazon has only gone up a little bit, the same $32.30 call that is, what is it, $147.90 here, was today, it's trading around $57.25. So this is also like a third of the value. Time decay, because the market hasn't really moved that much, like there's all kinds of variables when it comes to pricing out an option. We're not going to get into that because that would be a whole webinar in itself, just option pricing. But this is why we're getting into the different plays and why you would use them. If you were long the stock, all good for you, you're up money. If you were long the call, even though it's going in your favor, the market rallied around $50. When you buy an option, you have time decay, and that works against you, and it moves really fast, especially with short-term expiration. And that's why we're teaching you these different plays. Like, you don't want to use 2 weeks out just being long or an option, because typically you need to have a radical price move in order to realize any true return on that directional play. Reason being is time decay will erode that option, because whenever you buy an option or sell an option, time decay is a value, and the shorter time you have left, the faster it moves against you. So these options here, had you put them on, you would actually be down money had you bought this call. Buying the put, obviously with the market going up, you would be down money in that. So anyway here, the only way of these three situations would you be up is if you bought the stock, but look at what you would have had to put up. Now, if you would have sold 100 shares of Amazon short to be a bear, high margin and unlimited risk, obviously you'd be out $50 a share times 100. So then you could have sold a $32.30 call. Now this is where, remember, how this option went down in price, even though the market went up, you could have sold that option for $14,790, but you would have unlimited risk. The thing about this is, and this is why I said people do sell them, and there's no reason not to, is that had you sold that option right now, you'd be able to buy it back for a third of what you sold it for, and then your risk is off the table. Now, the one thing though is, had Amazon rallied more than $50, what if it pulled a Tesla or a GameStop and all of a sudden it rallied like $400? It's not like that couldn't happen. Well, then whoever was short that stock would be obviously screwed, and then also the same thing would happen for anyone that sold that call, because they would have to make good on the stock at that price. So now if you own the stock already and you sold the option, worst thing that happens is they take the stock away from you. You made the money on the selling the call, and then that's a good thing. And that's where actually you can make money, when you own the stock already and you sell a call like that to make the 14,000. Think about that. You're already up on the stock. If the worst thing that happens is the stock rallies, you don't see that big realized return for owning the stock anymore, but you did make almost $15,000 up front in a short amount of time, and you're out of both positions, and then you have a bunch of capital to work with. So now if you sold a 235 put, remember that would be for a credit of $13,904. In that case, obviously, that put would be down to, what is it, $8.85. So that option would have decayed also. You'd be able to buy that one back actually at a profit as well. And that's with, obviously, because the market is $50 higher, the put, selling a put, any puts you sold would be going in your favor anyhow. Okay, so hopefully you got that understanding. Now, as far as the call credit spread, remember that would have been short. So $540 is what you would have risked and have under pressure. And right now, with the way the spread is, you would be down to, what is it? The spread is very small now. Yeah, it's probably about less than half of that right now. As far as the put credit spread being long, that $416, that would be pretty much money in the bank at this point. With the 2 days left, it would be great just get out of the spread if you were to have had it, because the couple dollars it would cost to get out would be irrelevant, and you would still be up that money right off the bat. And the same thing is for a call debit spread going long. You would have cost you $540. Now, because the market has moved $50 and it's above your strike prices, there's no more realized gain that you could have in your debit spread. So that would be the time to get rid of it. And then also your put debit spread where you are short. Well, obviously that's gone to zero. So there's nothing, you could just might as well hang on to it in case Amazon all of a sudden collapses in price between now and the expiration on Friday, in which stranger things have happened, especially in the last year as far as market volatility. All right, now we're going to move a little bit faster. So Tesla, in this case, you would be buying it. When I did this slideshow at first, it was $864.16. As you can see, that's in between this first blue line and this first red line here. Remember, the blues are calls, the reds are our put prices. Okay, so Tesla today is down. It was trading around $814 before around lunchtime. So that means that in this case, had you bought the $865 put for $63.49, meaning you were going short, you would be in the right direction. Right now, that put would be $51.60. Now, there's only a $50 move. The reason that there was a $50 move and you're not up as much money as you would think with this put is because of the time decay. Time decay has eroded the value of this put. Remember that whenever you buy an option and you're only buying, time decay is in your favor when you're selling an option, and it works against you when you're buying an option. Now, the funny thing is, when we're talking about our credit and our debit spreads, time decay is neutralized. It doesn't matter at all, period. Nothing. It doesn't mean anything as far as the pricing, because you're net neutral. Where your time decay is hurting you on one option, it's helping you on the other. So they have a cancellation effect. So that's why credit spreads and debit spreads, they take out a lot of risk. They help you define your risk and let you enjoy a lot of things that market movement happens, and you can take an opportunity and you don't have to have all the stress. Okay. So now, if you would have bought the call, you would be losing money on this one. This call is now down to $2.55. So, but look at this. If you would have sold the put, obviously the 865 put, you would be sweating it right now, unless you own the stock to cover any exercise that could happen against you. Because remember, in this case, you would be going long and the market went down. But had you sold the 862.50 call, this is where time decay really helps you, because the 862.50 call now is worth $2.55. So this call right here you would see a realized value of basically $64 or 60. That's a lot. That's a lot on this, because when you add, we'll get to the next slide, you'll see how the numbers are. So if you did a credit spread here, now this is where it's nice and interesting, is that if you did the credit spread, you would have been selling the first strike price call above the market at 865 for 63.80 and buying the 875 call for 57.90. This would have given you a net credit and you would then be bearish this market. So in this case, this credit spread is in your favor. Like with 2 days left to go, anything could happen with Tesla. I mean, Elon Musk, this guy just spent $1.5 billion on Bitcoin yesterday. Who knows what he's going to do today that can make, we've seen Tesla jump hundreds of dollars alone in just days. So right now, if you had on this spread and you were up on the short position, 2 days left. Don't get greedy. There's nothing left in this trade. Get out of it. Take your money and run. Now, had you put on the put credit spread, that would be a different story. You're screwed. You were long. You're out. That money, that position is pretty much worthless. In this case, you might as well wait and hope that Elon does something crazy between now and Friday morning to make Tesla's stock. Well, it could be up $200 tomorrow for all we know. So in that case, you would just hang on to that one. Now, another way to be long would be to do the call debit spread, right? So in this case, it would be just be the flip side of doing a credit spread. And obviously with the put spread where you're short, it's the opposite of doing the put credit spread where you are long. Let's see what this all totals out to. So for your vertical spreads expiring tomorrow on, or excuse me, Friday on February the 12th, your call credit spread, which is a short play, you would have brought in a $590. Okay, per spread that you execute, okay? And that would be short. So right now you would be in the money on this spread here, and for $590, and let's see what would be the credit to get back out. Yeah, now you could do it for like $1. So there's like only, you would realize over $400, almost $400 on this spread if you were to get out of it right now, if you were to buy it back. Remember, there's 2 days left. There's next to nothing left in it as far as any vig, meaning any price left. Getting out of a short position like this would be, if you had done it at this time, would be a good time to do it. Although time decay, remember, is going so fast that this thing tomorrow, if you look at it, probably is going to be half the price of what it is today. Also the same thing now, it's put credit spread. Had you been long, this one you would have brought in a credit of $691. So yeah, you'd be out the $300 on this one. It's already worked into the price, so it wouldn't change a thing. You might as well just leave it to expiration and pray that Elon Musk says something that makes the stock go up $200, and all of a sudden your put credit spread would become in the money and be a winner. Another reason to get out of your call credit spread. The opposite here is for the debit. Remember, if you're doing a call debit spread, that's the same thing as being long. In this case, you would be down this $590. The market's down at the bottom. There's nothing left. You would leave on the spread. There's no reason to get out of it since you've already lost. It's already down to basically zero. So now you give it 2 days, and once again, hope that Elon comes out of nowhere, and sets it up for a big rally between Friday morning and Monday, over the weekend. Then we have the put debit spread. If you were short here, where 691, you pretty much have your money in the bank, collect what you can. You'd only cost you probably about $120 to get out of it, and realize your $500 and some gain. All right, so costs for this whole February 2012 expiration. If you bought 100 shares of Tesla, it would have cost you $864.65 a share, or $86,465 of your capital in your account. If you were to buy the call, it would have cost you $6,653. Okay, which right now you would be out that money right now, pretty much. It would be dead between time decay and the fact that where the market value is at, market price is at. This option would be worthless. Remember what I say, the $862.50, yeah, it's worth $2.55. So it's only worth $250. Considering you already lost $6,400 and almost all of it, you would just stay on that for 2 days and see what happens. Even like a $50 rally tomorrow would have you being able to sell it out and maybe get $500 back. So I would definitely wait on that one if you were to be still long that kind of a trade. If you bought the put for, it costs $6,349 at this point, since you could buy it, see, the thing is, it's still expensive because of the premium. It's 51. So you could probably say that this might be a good time to get back at that one. So I don't know. This is kind of iffy. It's right there on a borderline price. So remember, time decay takes a lot of value out of the put pricing. So at this point, you probably would want to just wait for it to expire and just take, or you could get out of it, but you could probably give it another 2 days. It wouldn't matter. If you sold 100 shares of Tesla short right now, you would be up money. However, you would have unlimited risk. And remember, he could say something crazy overnight tonight, and tomorrow the stock's $200 higher, and you would be out a lot of money. Then you're starting with 86,000 right off the bat. You'd be definitely being burned a lot. So, or you could sell the call, think for a credit of $6,653. But remember, you had unlimited risk. But right now, if you did sell that call, you'd be able to buy it back now for $255. Which, had you sold this call at that point, that would have been the thing to do right now is to buy it back. You'd be making $6,400. Your money is done. Your risk is off the table. If you would have sold the 865 put for a credit of $6,349, well, in that case, you're screwed on this one because you're out all that difference. Hopefully you own the stock at that point. That's why high downside risk. It's unlimited. Remember, we don't like things like that. Or, well, you can do it, but you better know how to cover yourself still with that, or you're going to have some troubles with your margins, that's for sure. The call credit spread, remember, that was a short play. You brought in $590. That's a pretty good play. Getting out of it right now would not be a bad idea. The put credit spread, which would have been a long play, remember, you would be out the $691 on this one. Or actually, you'd be out $1,000 minus the $691. That would be the difference that you would be out on that one. The call debit spread, which is a long play, $590 is what it costs. You'd be making $1,000. So you'd be making $410 on that one. That's a good play. You can get out of it now and maybe only make $350, but still you'd be able to make money on that one. The put debit spread, which means a short of $691. In this case, you take that minus $1,000. That's the money that you would, or excuse me, the put debit spread rather, which we are short here. In this case, you would be up money on this one. And, we just have to see what the pricing here. I would say you might want to let that one go for another day or two if you were to have done that one. So we're going to do one more quick one. We're going to blow through this one and then answer some questions out there. Okay, so for this one, we're looking at Microsoft Corp, which at the time of the making of these slides, it was trading at $232. Today at lunchtime, it was around $241, $242. So really no market movement. This is where you're going to start to see where time decay really makes sense because the numbers before are so big, it's kind of hard to look at. So let's take a look at this. If you were to buy the 235 put and go short, it would have cost you $8, which is $800. You could have bought the call of 232.50, which would have been a long play for $752, which is $7.52. Or you could have sold the options, obviously for the same prices, in which case selling the put makes you long, selling the call would make you short. It's the opposite. For the call credit spread, you would be short. You would be selling the 235 call for $6.20 and buying the $245 call for $269. The credit spread for the put spread would be selling the 232. That's this lower one here and this lower red. This is kind of hard with this chart because it was in such a rally that these call strike prices are up here. Here's your 245 call, your 235 call. So the put spread you can see here where you have the 232.50 put here and the 222.50 put here. That's where you would have remember, credit here, and that is also the long play. Conversely, for a debit spread, remember where it costs you money up front. If you were doing the long play, you would be buying the 235 call and selling the higher call above it, the 245 strike price for 269. Conversely, for the put spread, you would be short, meaning you would buy the 232.50 put and you'd be selling the 222.50 put as well. So for these vertical spreads at expiration, your call credit spread, once again, you would be short. You would be bringing in a credit of $351. The put spread, you would be long. You'd be bringing in a credit of $345. Conversely, for the debit, this is what you would be paying out for it. Now, remember that this pricing, unlike the other two examples, the market's only moved $10. It's not a very big move. So what would mean, in pricing wise, what would be the thing that would have affected these options the most? If you've been paying attention, time value. Remember, time theta decreases at a high rate the closer you get to expiration. So the value and pricing of these options would be the only thing that would be really affected the most because there's no movement. It's only $10. It's not that much of a difference in price. I mean, $10 is a decent move, but not when the stock costs $240. So in this case, if you bought the 100 shares at $232.90, now it's at $241.77. So it would have cost you $23,290 to get into this position, and then now it would be obviously up. The call would have cost you $752, and now that would be a debit in your account because you've been purchasing the option, okay? And that would right now be $9.17, so that'd be $917. So considering that you have 2 days left and you are up after a $10 move, about $100 and some dollars, $150, $60, I would say getting out of that call would be the right thing to do because you only have 2 days left. As far as buying the put, which gives you the right to be short, you're out $800. It's pretty much worthless. You would just let this go and hope that Microsoft really falls through the floor over the next 2 days. If you were short 100 shares, your margin would be super high. You would have your unlimited risk, remember, and you would be down you'd be down $10 on that position times 100. If you would have sold a 3250 call for a credit of $752 and had unlimited risk, obviously you would be down on this one. Hopefully you own the stock. Otherwise you're going to owe, well, it depends if it rallies even more money because someone is going to be buying it from you at that strike price. The strike for the put credit spread, or excuse me, selling a put would be $800. In this case, you still have high downside risk, but this one right here, you would be up money because the market's been rallying. Since there's 2 days left and anything could happen, I would say take your money and run if you would have sold the put. For the call credit spread, being short, $351. In this case, you would be down a little bit of money. But see, here's the thing is that the spreads, the difference sometimes doesn't, the pricing moves, but the credit doesn't move and the debit doesn't move because since the market didn't move, this really wouldn't change very much. So getting out of it, you might as well just leave it to expiration because the market hasn't moved, whether you're short or long very much. So the short one, you'd be out a little bit of money. You could maybe buy it back if you wanted to get out of it. But your difference of what you would lose or not lose would be slight. So you might as well give yourself that 2 days of time. Remember, time meaning till expiration, not because of the decreasing in price, because of the time value. Your put credit spread would be $345. And then your call debit spread, if you were long this, your debit of 351, you would have some value in this one. So you could buy it back, or excuse me, sell it back and make a little bit of premium because of the $10 move. The put debit spread where you'd be short the 345, you pretty much have exhausted your pricing on this one. So for the 2 days left, I would say you would give that more time. So remember that these strategies, if you want to learn how to maximize your options trading potential, there's ways you can do that. First of all, you use eOption for your stock ETF and ETF option trading. There's also their option strategy tools like Options Play that you can use, and you can use these strategies and try and apply them and see how time and also how certain things would apply and impact these strategies. Remember, we chose the 2 to 3 weeks expiration, showing you how the vertical spreads, even though your return on investment it's very high for the amount of money you take in, but you can have a lot of market movement. It doesn't matter. You're only looking for X amount of money, but the thing is you can make that in a very quick amount of time. The other plays, whether you're outright the stock or ETF, or if you bought the calls or puts, remember you need to have a big move in your favor or else time and other things will go against you. And also you have high capital outlays. You could put on a lot of spreads for the differences here. We're going to get to your questions in one quick second. Remember, there's a free paper trading account also at eOption that you can use to test your strategies. Your ETF and stock trades are free, commission free rather, and your options contracts are only 10 cents per contract. So questions about the webinar option strategies and applications. Remember, you can always learn more at eOption. Let's see. I got your questions. Let's see. Is this trading based on U.S. markets? Yes, these are all from the NYSE and the NASDAQ. Anonymous NT. So when you say you don't want to be long 2 weeks out on a call that expires 2/12. Okay, so here's the reason why you don't want to be long necessarily a call that's when it's only 2 weeks out. Remember, time, it moves fastest, where time decay will erode the pricing. So when you buy an option, just the buying of it means that that price is going to erode. If it doesn't move, if the market doesn't move at all, the time value alone is going to make the price of that option go down very quickly. So let's just say it was 5 when you bought it with 2 weeks left. Within a week, it's going to be at 2 just because if the market doesn't move, just because of time. Okay, so you need the faster time is moving, the bigger market move you have to have in your favor to compensate for the money that you're losing from that premium. Okay, so let's see, what are the cons and pros of credit and debit spreads? Okay, the pros and cons of credit and debit spreads are super easy. The pros, no matter what, for both of them is that you have defined risk. One of the biggest things for when I don't care whether you're a bull, a bear, how you figure out when you want to go long or short, whatever market, you always need to define your risk. You always have a trading plan, have a value for your risk allocation. And this is the thing that this kind of trading strategy fits in that model perfectly, because you know 100% when you sell a credit spread, what is the most money you can risk. When you buy a debit spread, you know 100% the only money you can risk and lose is what you already put out. So you can't even lose them. It's already out of your account. It's already done as far as you're concerned. The best thing that can happen is you make money and you have money that comes back. Now, as far as cons, the con is that if you use a credit or a debit spread to whether you're being short or long in your direction, remember we showed you how you can use a credit spread to be short or a debit spread to be short, and also conversely to be long either one. Depending on that, if you have a major market move, like remember, if you buy a stock and it goes to the moon, you're only going to make on your credit or debit spread, if it's a bullish one, that difference between either your credit or your debit. Okay. Whereas if you own the stock and it kept rallying like $100, you're going to be beyond your strike prices. You would realize all of that gain. So you don't have unlimited upside potential with credit and debit spreads, but the controlled risk factor is one of the most amazing factors and opportunities for any investor or trader to truly take advantage of because of defined risk. And then you know what your ROI is. So instead of putting up hundreds of thousands of dollars to buy Amazon stock, get longs from credit or debit spreads, and you don't have to put up hundreds of thousands of dollars. Now, of course, you're not going to see those big returns to the upside, but they don't pay a dividend. And you know what? If that goes down, you're out a lot of money. So you can control your capital much better. Let's see. I see no mention of risk regarding credit spreads. Wait, that's bouncing around. There's so many questions coming in. Excuse me. I see no mention of risk regarding credit spreads that go south and suddenly get early assignment on expensive shares. Okay, well, here's the thing is, when it comes to a credit spread, your risk is only the difference between the two strike prices. Okay, so when let's say it's $10 wide. So if it's a 220 strike price that you're selling, and then you're buying the 230 strike price, okay, above the market, that credit that you take in, whatever that pricing is, no matter what, you're only risking $10 of market movement. It's always defined. Okay. So absolutely, that is the risk. And it doesn't matter about assignment of anything or whatever, because you can only make so much on a credit spread and you can only lose so much no matter what the market does. Early assignment, you don't have to worry about it. That has nothing to play into that. Now, if you're talking about early assignment when you have other positions on, like when you're naked an option, where you sold an option like a call or a put, that's a totally different story. And that's why we discussed how, remember, you don't want to be like those hedge fund managers that got, they're everything handed to them on a plate, that's for sure. So remember to always define your risk. That's why you use options. You hedge yourself in market movements by options, and it's a cheap way to do it. It's basically insurance policies that pay off all the time. Now, sometimes they don't. There's also times where you don't want them to pay off because you're making money somewhere else, especially if you own the stock. Do you accept Canadian clients? You have to refer to the options trading desk. They'll help you out with that question. Do dividends have an impact on your liability when option trading? Well, absolutely. The dividends coming out can cause volatility in stocks, especially if they change them, like increase them or decrease them by a big amount. So that's how they would. As far as pricing and stuff, obviously volatility creates option pricing differences, whether up or down, depending on the increasing or decreasing of volatility. So yes, good question. Dividends do have an impact, but it could be slight, it could be huge. It totally depends on the move of whether, like, for instance, if they stop all of a sudden cut dividends or something, like not even just cut them, like completely cut them out, like that would change a stock's price and value for sure. What about leaps with eOption? Those are questions you have to talk to the trade desk about. When would you use a spread of only $5? That's easy. We were looking at stocks that have such volatility So $10 wide is nothing, you know. It was for pricing, you know, when you're looking at Amazon and Tesla, you know, stocks that are 800 to, you know, multiple thousands of dollars versus a stock that's 55, you know, if you have a stock that's trading like Coca-Cola around $50, then yes, absolutely, you would have spreads that are only $5 wide. In fact, a lot of times you can get some of your best value on credit and debit spreads with the tighter options. So especially because people don't watch them as much, they're not as sexy, if you will, as some of the high flyers. So let's see, we still have a couple minutes for some more questions here. This is really good. You guys got a lot of good questions today. Is a credit debit spread also known as a straddle? No. Okay. Straddles and strangles are, remember, where you are simultaneously, those are vertical spreads as well. However, straddle and strangle is when you have the same expiration. Okay. A straddle is when you have the same price, same strike price, put and call, and a strangle is when you have, there's a little spread between them. The only difference is that when you're buying those are directional plays. So you just want the market to move. When you're buying a straddle or strangle, you don't care which way it goes. You just want it to move away, especially when you're buying them, because time value will decrease that price no matter what, because the time value when you buy a straddle or a strangle, both options will be losing money, time decay, every single day. So the price of that option will be decreasing whether it moves or doesn't move. So price movement is super important. Whereas with credit and debit spreads, the market doesn't even have to move. All it's got to do is expire. So it either has to move or expire, and then you know what your risk and what your potential reward is, you know, which it's only when it moves against your direction of your credit or debit spread that you know you're going to end up losing money, but your risk is defined. If it doesn't move or it moves in your favor, then you make money, versus straddles and strangles. Very good question, but that's a nice thing where you learn about time decay too, because remember, when you're now, if you were selling a straddle or strangle, time decay works in your favor, but then you have unlimited risk. So that's a totally another topic for another webinar. Can you explain the option Greeks? Well, that would be a whole webinar in itself. Time decay is the theta. That's, you should hopefully have gotten a little better understanding of how, when we looked at these options, how within a short amount of time, some decay a lot, like when you do the outright puts or calls, or when you're buying on an option, you know, any type of options, versus when you sell them, time decay works in your favor with short amount of time. Now, let's just say you had an option that's 4 months out. Well, then time decay, you have a lot of time. So the time pricing isn't really moving. So if the market's not moving and just a couple days go down, your option price doesn't really move because of time decay, because you have 4 months out. Now, if you have 4 days out, like now we have only 2 left, or 1.5 going into, or 2 days left, yeah, 2.5 rather, going into option expiration. Time decay is almost all gone, and whatever's left, it's going to erode very, very quickly. So if the market doesn't move, that's going to that premium, part of the premium will be gone. Then there's delta and a bunch of other things that we have to get into as far as how much the market movement goes. All right, so we're going to wrap this up now. I'm going to show you one last thing real quick. Really good questions. I'll try and answer some of these after we turn this over to Gina. But I want to remind you to check out my YouTube channel, Forex Trading Unlocked. If you like this webinar and the information you got there, I do all kinds of other presentations, and also remind you about checking out the book High Probable Japanese Candlestick Patterns, available on Amazon.com in paperback and Kindle versions. You can apply these option strategies with these candlestick patterns and have a way of helping to find you get some good signals. That's which you can find out by reading the book. And so for more resources for you, I want to remind you about eOption.com for more option trading resources. To watch more videos of options tradings, you can subscribe to their YouTube channel as well, eOption at YouTube. And then also get the, or obviously since you watched the webinar, you're going to be emailed a copy of it anyhow. And remember that their next webinar, mark your calendar, is Thursday, March the 4th at 1 p.m. Central Standard Time, bullish and bearish options strategies. Sign up at eOption.com/webinars. And thank you very much.
Okay, great. Thanks so much, Teddy. We really appreciate it. That was very interesting and informative. And on behalf of eOption, we'd like to thank all of our attendees for taking the time out of your busy day and for all of your questions. Those were great. And if you want to trade some of these strategies, don't forget to take advantage of eOption's low rates. We charge just 0 commission for online stock and ETF trades, and options are just 10 cents a trade plus $1.99 a contract. And we know some of you on this call are already account holders, but if you're not and you're interested in opening an account, just feel free to go to eoption.com and you will find buttons there to open an account, and it's pretty easy to get started. We also have a paper trading account, so if you want to try us out, try our trading platform, put your watch lists in there and your news and alerts, you can definitely give us a try with a paper trading account. You'll get $100,000 in virtual currency to get started, and that's free of charge. And a couple people in the chat room asked if they'll be getting a copy of this, and yes, we will be emailing all of the attendees a copy of this so you can watch it at your leisure, and you should receive that in the next few days. And it will also be on eoption.com. We have a resources and education page that has a lot on there, and it will also be on our YouTube channel. So lots of ways you can find a copy there. And we do have, I can't stress enough, I hope you'll go to eoption.com. We have all kinds of education on there for you. You'll find clickable strategy links with videos. So for example, if you want to find out about a certain spread or option strategy, you can just click on the link and it'll tell you all about it, as well as videos on how to use that strategy. We also have all of our past webinars on our website. And then as we mentioned, Options Play is our trading tool. It basically scans thousands of stocks each day and highlights option trade opportunities for you if you're looking for trading ideas. And that's normally $500 annually. And we do offer that free to all of our customers. And also feel free to give our trade desk a call. We're happy to answer any of your questions. And that number is 888-793-5333. Again, 888-793-5333. And that really differentiates us from other firms. I know there's a lot of firms out there where you can just use a trading app and it's really hard to speak to someone, but we pride ourselves that it's easy to get through to speak to a licensed, experienced broker, and we're happy to answer any of your questions. So if you have questions about a particular option strategy that Teddy mentioned today, or just how to use our trading platform or get started with our tools, we're always happy to talk to you. So give us a call. And as mentioned, we hope you'll check out our YouTube channel, and the link is on the page that you're looking at. And we just revamped that. We're pretty excited about it. We have all kinds of new playlists. So if you want to get into covered calls, you can click on that. You'll see all of our past videos on that. If you want to get into more complex strategies, you can also click on that playlist and you'll see all kinds of webinars come up. If you want to use our trading platform, we have all kinds of videos on how to get started and enter complex option strategies. So we hope that you'll check that out. And someone asked a question about the Greeks. If you go to our YouTube channel, we did do a series on the Greeks. We did one on Delta and Gamma and one on Theta, Vega, and Rho. So if you do go, you will see some videos there where you can get started and learn more about it. And as Teddy mentioned, we hope you'll join us for our next webinar that's coming up in early March, and that will be sponsored by the Option Industry Council, and we partner with them a few times a year. So we're very excited about that one. You can go to our website and sign up at eoption.com/webinars, where we will be sending out some email reminders leading up to it. You can also sign up there. So again, thank you so much for attending. We know you have a busy day, and we appreciate you taking the time out of your day to join us. And be safe, and we'll see you soon at the next webinar on March 4th. Thank you again. Bye now.